Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock with news China data is triggering investor fears. But first in the US, the regular debt limit impasse is on us yet again, with a shutdown looming from this Saturday night if a resolution can't be found. American retail sales data for November came in flat compared with October, but up 4.2% year on year. This matched analyst expectations and is seen as a good sign heading into the heart of the holiday shopping season. US industrial production recovered slightly from a poor October, but the gains in November were average. It doesn't seem that December will get any better, however. Early December US PMI readings show their manufacturing sector expanding at its slowest rate in 13 months. In China, most of the data released over the weekend indicated growing weakness, data that may be behind the stock market reversals at the end of last week. Nominal retail sales in China rose 8.1% year on year, and that's the slowest such growth rate in 15 years. Data for industrial production was down to 5.4% year on year and well below analyst estimates. In official data, China's home prices have been described as stable, with growth evaporating as demand dries up. Russia's central bank unexpectedly increased borrowing costs for the second time this year, increasing them by 25 basis points to 7.75%. It also signalled it may raise them again as inflation jumps to over 4%. In Ireland, politicians responded to historic banking misdeeds by imposing severe limits on bonuses and banker pay. But that has caused a growing exodus of talent and revolving doors in key positions. In fact, Dublin has become so worried about the bank management skills, it is about to issue a report recommending a sharp easing of the restrictions. At the end of last week, equity markets took a beating. It started in Shanghai with them closing down 1.5%. That has compounded to a 23% loss for the year and well into a bear market. Hong Kong was down 1.6% on Friday. Tokyo was down more than 2%. That weakness flowed through to Wall Street with the S&P 500 down 1.9%. From the start of October, the S&P 500 is now down more than 11%, and that means it's in a technical correction phase. Where to from here is a key question for investors and for business managers who need to make investment decisions. And December is on course to be the first month without a sale of sub-investment grade corporate debt in the US since the Lehman Brothers crash. American high-yield bond markets are tightening and fast. US Treasury 10-year yield is starting the week at 2.90%. Their 210 curve has risen to just under 16 basis points. And gold has slipped back and is now at $1,238 an ounce, a $10 fall over the week. And US oil prices are down sharply again at just over $51 a barrel. The Brent benchmark is now just over $60 a barrel. And the Kiwi dollar is starting the week softer at 68 US cents. On the cross rates, we're marginally softer at 94.7 US cents and a little change at 60.1 euro cents. That puts the TWI a little lower than 72.8. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.